Your stocks and your commodities have plunged globally, as you've mentioned, and investors have ploughed into what are regarded as safe haven assets. That's your gold, your US treasuries, your German bonds, and your yen. And in the meantime, the oil price has taken a little bit of a hit as well. It's still, still firm around the $48 a barrel mark. But, the implications of a Brexit are so uncertain. So it's very difficult to tell whether this massive reaction on the markets is going to be just a blip or whether it's going to continue as the uncertainty continues. Well, with me, I have a portfolio manager who looks at the markets all the time. That's Gary Boyson. He's from Rand Swiss. Thank you very much for joining us. And I don't know what to say. It's a shocking day. Yesterday, the smart money, so to speak, was not so smart, betting that there would be a Remain, but there's been a Brexit, and there's been a massive reaction on the markets. Your thoughts?
Yeah, I think the size and scope of the reaction is expected. Everyone was pricing this in as a Remain, but bookies had it at about 90%. The polls were still calling it close. Interestingly, we spoke to a social media expert yesterday as well, and they actually said there was a 65% chance that there would be a Brexit. So I think they surveyed about 250,000 UK Twitter accounts. So interesting that social media is now a better predictor than like you say, the smart money. But the market wasn't priced for this. If you look at what happened in China, towards August last year, where we had the volatility picking up in the Chinese markets coming off, the VIX got to about 40 at that stage. Yesterday, the VIX was at 18. That's telling you that the market was pretty unconcerned about Brexit, and now having to scramble.
Now, we see winners and losers. Gold, obviously, people ploughing into that. So you see your gold counters doing very nicely. Goldfields up 16.3%, Harmony 16.2%, Anglo Gold Ashanti 14.1%. This is huge for them, but obviously it much depends on how the markets go on. And then the losers, we see the financial sector not doing well at all. Commodities completely smashed. So what do you think is the prognosis, particularly for the financial counters, especially given that London is a financial hub right now, and that may change?
Yeah, already in London, there's been all sorts of talks about the major banks moving their headquarters, into Europe, and I think as a financial hub, it's going to suffer. There's no question about that. We obviously trade a lot of offshore counters as well, and a lot of our offshore research providers were saying that the way to play a Brexit is really to go short banks and long UK healthcare companies, and that's how it seems to have been. It seems to have been a good trade. So, yeah, it's just astonishing. If you look at our local banks, our local banks are obviously getting punished as well, because with the blowout that we've seen in the currency. Remember our market. Some of the UK markets are down 10% today, but at least the European markets are down 10%. Our market only down 4-5%. Now that's really the shock absorber, that effect that we're getting from the currency, because the rand blew out 7% this morning as well. So that's taking a little bit of the pain off our market, even though we are down dramatically. Now the banks, obviously, we're looking at that and we're saying with the suddenly very weak currency, this is going to feed into inflation expectations. We're suddenly going to see probably the Reserve Bank having to continue with a rate hiking path, whereas after the fairly good inflation number we got out earlier in the week sort of indicated that maybe in July we were safe, and that we could focus on perhaps a more accommodative policy to try and stimulate local growth. So that now is out the window. So it's definitely going to be an interesting one. And again, the banks will react to that currency move as well, because a lot of their business is inside South Africa. There's also been estimates that just because of the different agreements, it should shave about 0.1% off GDP if the UK was to leave. So it's going to put our growth rate under pressure again, which is also not good for our financial sector.
Sounds like it's going to knock global growth altogether. We're going to leave it there. Thank you very much, Gary. Well, that was Gary Boyson. He's from Rand Swiss. It's back to you, Ibn.
Yeah, thank you very much, Nompumelelo.